very quick check on the major stories of the day until we're waiting for Mark Oswald. I just wanted to show you very quickly. Are you there, Mark?
Yes, I am. Yes.
Good morning, Mark Oswald. Thank you so much for joining us. Mark Oswald, ADM Investor Services, and of course, Happy New Year.
Happy New Year.
So, Mark, of course, we would like to kick off with the ADP report, which was pretty positive, well above expectations, by the way, doubling expectations. So, was that a number that you were expecting?
To a certain extent. I mean, what we have to remember is the November labour report that we had, the official data. Actually, if you looked at the household survey, which generates the unemployment rate, as opposed to the establishment survey, which generates payrolls, was actually inordinately strong. Demand for labour is strong. We've seen that in most surveys. We've got over what were a lot of the hiccups. Okay, there are hiccups in terms of people being able to get to work because they're testing positive here and there for the Omicron variant, but that doesn't actually change the underlying picture that the demand for labour is very, very strong. And so this ADP report, I think the important thing to remember is it correlates better with that household survey, i.e. the unemployment rate, and therefore it bodes well for the unemployment rate when we get it on Friday. On the other hand, of course, I'm sure there will be a number of people thinking, well, doesn't this make the Fed probably want to just ratchet up, winding back its balance, or rather completing its taper and then hiking rates? So it's a double-edged sword.
So in tonight's minutes, I say tonight, of course, I'm referring to Central European time, 8 p.m. Italian time, and of course 2 p.m. Eastern time. What are you looking for at the Fed minutes? I mean, from one side, I guess, rate hikes, and on the other side, a balance sheet.
Well, I think it's going to be interesting what the debate was. I think we've got a few clues, given that we've had one of the biggest archdoves, i.e. Mr. Kashkari, basically saying he's basically for 2 rate hikes this year and for completing the taper in greater time. The interesting part for markets will be, was there any debate? At what point do they actually start quantitative tightening? Is there any debate going on at that stage, or are they, for the time being, just wanting to end the quantitative easing, i.e. the additional thing, and for the moment not considering that and rather using the rate lever on this front? So that's really where the critical part is. What discussion was there around about quantitative tightening?
When it comes to inflation pressures to the upside, do you think that the U.S. actually peaked? Inflation in the U.S. peaked, of course.
Yes, absolutely. No, I doubt it very much. If you look at, for instance, this new index of supply chain problems that the New York Fed has produced, it doesn't really appear to be easing. The whole thing with the Omicron disturbances, the fact that we're actually in this problematic place in the world, with China basically still operating a zero tolerance policy and therefore constantly basically giving us the threat of supply chain disruptions from China. And people say, well, we'll start to look for alternatives. It's all very well to talk about alternatives, but we're still a long way off for actually having the infrastructure to shorten our supply chains and exclude China from them. So the supply chain disruptions are going to last for quite some time, and as long as those supply chain disruptions and upward pressure on energy prices exist, then we're not passing. We are definitely not in peak inflation area. Now, obviously, there is one key element in this, and people need to make sure that they don't get deceived by it, and that is at some point, probably in Q2, Q3, we are going to see very beneficial base effects on inflation. However, what we need to remember in terms of inflationary pressures is a lot of companies, and this is true the world over, we saw it earlier this week with IKEA, they have been absorbing a lot of the cost increases. Now they're actually starting to pass them on. And it's in that secondary level, and also in terms of consumers who are basically going to be facing higher energy bills, higher food costs, higher housing costs, that we're actually going to see how much real inflationary pressure that there actually is.
You know, talking about inflationary pressures, I just wanted to show you very quickly what's going on here in Italy. Today we saw, of course, the inflation rate here near at 3.9%, which is perfectly in line with expectations, but expectations were already high, that's for sure. Then we also got a harmonized inflation rate year on year at 4.2% and month on month 0.5%, which was slightly above expectations. So, Mark, I was wondering, the ECB members, of course, and the board of director members are always trying to convince people continuously that actually European inflationary pressures to the upside have peaked so far. So do you agree?
Well, they certainly, the ECB is certainly trying to talk that way. We had exactly that comment from Mr. Villeroy this morning. On the other hand, we had Martin Kazaks from the Latvian Central Bank basically saying, look, they may not have peaked. We may go further. I suspect actually the pressures are going to increase. Now, the question for the ECB then is, because if we remember what the Lagarde dictum was back in December, is she was emphasizing the fact that most of the inflationary pressures were, I think she said about 2/3 were all related to energy costs. Those pressures aren't going to go away. They simply aren't going to go away because a lot of it is to do with infrastructure. Yes, it will be helped to a certain extent by LNG deliveries coming in to replenish natural gas stocks, but we've got a cold, hard winter ahead of us. You can see it across most of Northern Europe. You look at oil prices, they aren't coming down in any great hurry. People are actually basically bidding oil prices up on the back of the fact that actually the disturbances or disruptions, one should say, to consumer demand and business demand for oil-related products is not going to be that great thanks to Omicron. So those aren't going to go away. The question then is, do they change the narrative and say, well, actually those energy pricings pressures that we were dismissing, do they now start to spill over? And here we go again. This is sort of what I would call IKEA syndrome, for the sake of just citing one specific company, but there's numerous others. Do they then start to trickle down? And at that point, what does the ECB do? Because at that point, then it will start to actually have to get somewhat more anxious. And, as Mr. Villeroy was saying, well, maybe we actually will need to revise up our forecast, but we've got time. So the ECB is definitely leaning still very much on the side of we don't have to act now, but they still could give us a nasty surprise in the second half of the year, would be my guess.
In final take, Mark, I was wondering what are going to be the major drivers for the economic growth in 2022, considering, of course, all all the circumstances that we're witnessing so far.
Well, I think we've still got actually a lot of catch up to do in terms of inventory rebuilding wherever you look around the world. We still actually have a huge amount to go into the whole energy and energy transition. How much we actually get underway really depends on how long the supply chains are going to be disrupted. Hopefully not for the whole of the year. I can certainly see them lasting well into the second half of the year. The real question then is how much of a drag is the whole pressure on household finances from rising inflation going to be on overall consumer spending, which obviously remains the cornerstone wherever you look in the developed world.
Thank you very much, Mark Oswald, Chief Economist and Global Strategist, ADM Investor Services. Happy New Year once again, and hopefully talk to you very soon.